Hello guys, so the US hit the debt ceiling on Thursday, which forced the Treasury Department to begin taking a so-called extraordinary measure to continue paying the government bills. Treasury Secretary Janet Yellen told lawmakers on the 13th of January that these short-term moves, including the suspension of the reinvestment in the workplace retirement plan for the federal employees, could allow the government to pay its obligations until June, after which the US would be in danger of default on its debt. Is this situation likely to have a long-term effect on your money? In other words, I would say no. Okay, but let's see what the debt ceiling really is. The US government funds much of its spending through debt, which is issued by the Treasury. The current limit is $31.4 trillion, a lot of money. Raising this limit would allow the government to borrow more to cover spending already approved by Congress. Failure to raise the ceiling would mean the government would eventually fail to pay back its debt, including interest payments on treasury bonds. Technically putting it, the US government would be considered in default. What would happen with the US approaching a default? Well, the US has never defaulted on its debt till now, and it will very likely take steps to avoid a default this time around. Because of its reputation, the US debt is considered a risk-free safety asset in the world economy. However, a change in US creditworthiness would result in some sort of turmoil, like it was in 2011 when the US faced a debt ceiling crisis and received a downgrade in its credit rating. So really bad stuff happened in 2011 because everyone remembers 2008 but not 11. The 2011 US debt ceiling crisis was a political dispute between the White House and Congress over the raising of the federal debt limit. The US government had reached the limit of its borrowing authority like it happened right now, and Congress was required to raise the debt limit in order to allow the government to continue borrowing money to pay its bills. However, many Republicans in Congress refused to raise the debt ceiling without significant spending cuts and budget reforms. This led to a prolonged standoff between the two sides, normally how it will always happen, but with the potential for a government shutdown or even a default on the US debt. Ultimately, a deal was reached to raise the debt ceiling and avoid default, but the crisis had significant economic and political consequences. So even though it was raised and, let's say, in due time, it wasn't the best of times to be an investor in the market. Okay, so what happens if the US actually defaults? Because we need to ask that question as well. It's difficult to say exactly what would happen if the US couldn't pay its bills, but it wouldn't be a, let's say, normal default of a government. Let's take, for example, Italy. If Italy defaults, it would be because they didn't have the money in the form that the debt was owed in. And let's presume that the debt Italy has is owed in dollars, because that's the question we are asking today. Well, if the debt is in dollars, then that means that Italy couldn't pay its debt back. But let's speak of the US. Any US default would result from a political decision rather than an economical decision. Why is that? Well, since the US debt is in dollars and the US is the country that makes the dollar, so prints the dollar, that means that the US could easily print more dollars to pay back the debt. But for that, you need the debt ceiling to go up. So you need to raise the debt ceiling, otherwise, well, you can print more money. So the problem itself is that if the debt ceiling is not raised, the US defaults not from an economical perspective or an economical decision, but more from a political decision. Should we be worried or not? Well, we've been here for a lot of times. So the debt ceiling has been raised for like 45 times in the last 40 years, 100 times in the last 100 years, something like that. It's not something new. But let's see what happened when the deadline approached. So in 2011, when the deadline was getting close, investors became increasingly worried about the potential for a government default, which could have had severe consequences for the global economy. This uncertainty caused stock markets to fluctuate wildly, with the S&P index experiencing its largest one-day drop in 2 years. And it's something important because in the past 2 years from 2011 we had the recession, so it was a big fall. Also, the VIX, a measure of volatility for the S&P 500, also spiked as investors rushed to safe haven assets like gold. During the course of this crisis, the stock market experienced a lot of volatility. So S&P dropped like 19% from its peak, and it had its worst 2 days in the past years, and it caused a lot of uncertainty. The crisis was in fact resolved in a last-minute agreement, so it's not like the US defaulted, but the stock market did not recover as fast. and it took some time to stabilize. And I want you to think of this word, to stabilize. So it was hectic in the market. In the end, the consensus, if you look anywhere on the internet to what specialists say, is that the likelihood of a no deal is pretty much close to zero. But the imminent impact, the imminent collapse, the idea of an imminent collapse, it's still a lot for the people to take, and it will cause a lot of turmoil, and we may see the stock market going bananas for a while, closer to that moment and immediately after. So it's not something that I want you to think as, okay, be scared, get out of the market, more like be prepared for when that happens or if it happens. Because if you are prepared, you'll know what decisions to make and everything will be okay. But this is all. This is what the importance of the debt ceiling really is. And if you understand that, you are prepared, you're focused on when that happens, you take action and you may profit out of it. Because don't forget, the best moment when you can invest is during a crisis. That's when Buffett made most of his money. That's when Burry made a lot of money. That's when everyone makes a lot of money, but if you are prepared. This is all from me. I hope you liked the video. If you liked the video, don't forget to like it, actually like it, subscribe, share it because it helps me a lot, and we'll see each other in another video. Bye bye.